Have you ever heard the phrase picking up pennies in front of a steamroller? If not, it's a metaphor that is used to describe an investing strategy where the best case scenario is you make a small amount of money, and it's usually an investment where that's on a recurring basis. And the worst case scenario, you blow up. What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we are talking about why bonds are like playing Russian roulette, or said another way, picking up pennies in front of a steamroller. Imagine you're playing the lottery and you have to pay, $1, $2 a time to play, and if you win, instead of winning a bunch of money, you lose a bunch of money. Today I'm going to explain why today investing in bonds is exactly like that. Ready? Let's dive in. You might be thinking to yourself, well, who actually invests in bonds today? Because I certainly don't have any bonds in my portfolio. Well, don't be so sure about that. Bonds are automatically included in many ETFs, in many mutual funds, and in many automatically chosen 401k investment plans. And they're definitely a big portion of pensions as well. And so just because you haven't specifically chosen to include a bond in your brokerage account doesn't mean that some of your portfolio doesn't have an allocation or an investment into bonds. And that's particularly concerning because you're watching this video, you know a lot about money, a lot about investing, a lot about the economy, but you are not the majority. You are not even average. You are far above average in that regard. The vast majority of people have no idea what their money is invested in. Most people don't even know the difference between a stock and a bond, which means that basically there's a lot of money invested in bonds, and a lot of that money has no idea that bonds today are a terrible investment. And here's why. A bond is a form of debt just like any other form of debt, like a credit card or a mortgage or a car loan. Except if you own the bond, you are the lender, you are not the borrower. Just like all other forms of debt, there's a certain time frame associated with that debt and an interest rate associated with that debt. So if you buy a bond for $1,000, you're lending $1,000, and then at the end of that bond, they're going to give you all that money back, that $1,000. And if the bond time frame is long enough, they will have paid you interest along the way. If it's a shorter time frame until that bond matures, they'll just pay the interest at the end when they give you the whole lump sum back. Historically, the interest rate on bonds is usually somewhat above inflation. So if the inflation rate is 2%, you might be able to get 4% on your average bond. That means if you loan out $100, you're going to get $104 back in total, but the cost of living rose by 2%. And so before you made the loan, you could have spent $100 to buy item A, but once you got that loan back, once it matured, you got $104 back. Now if you go to buy that same item, it's going to cost you $102. So this is the difference between the nominal yield and the real yield. The nominal yield is the stated interest rate, in this case, 4%. The real yield is you have to subtract inflation out of that, because just because you're getting more dollars back doesn't mean those dollars will go as far as they did before. So you have to adjust for how expensive stuff has gotten in the meantime while you weren't able to use your money. That means the real yield was 2%. Today, real yields have fallen to a median level of 0.2%. That means some bonds pay slightly more, and some bonds, the real yield is actually negative. These would include things like short-term treasuries. That means you loan $100, get $101 back, but in that amount of time, while you were loaning that $100, the cost of living rose by $2 or $3 or $4. This means that right now, the best case scenario, if you purchase a bond, is that you lose a small amount of money in terms of its purchasing power. Your wealth declines a little bit. That's the best case scenario. If there's no default and you get all of your money and the bond matures, you get your principal plus interest. Best case scenario, you lost a little bit of your purchasing power. Worst case scenario is there's a default. Whoever you loaned that money to, whether it's the United States government, a city, a corporation, the borrower defaults and for one reason or another decides not to or cannot pay either some or all of the principal plus interest back to you. This is why I use the analogy of playing the lottery in reverse, where you actually still have to pay to buy a ticket. It's not like you're playing the house. You have to pay to buy a lottery ticket, but if you win, you actually lose money. So more than likely what happens is the bond matures and you get your principal plus interest. Very little chance of default, especially in a day and age where you've got the Federal Reserve creating money out of thin air and purchasing bonds in order to make sure that defaults don't happen. It's very unlikely that you'll see a wave of defaults on debt roll across the economy, but it's still a possibility. Now, you might be thinking to yourself, Yes, but interest rates have been low for a very long time, and bonds have still had a good place in a well-balanced portfolio. And so it's no different today than it's been for a couple decades. Well, not so fast. If you take a look at the reason why bonds have been a good portion of portfolio over the last couple of decades is because interest rates have been on the decline. Interest rates and the price of bonds are a direct inverse of each other. And so if interest rates are on the decline, that means the bond price is going up. But with real yields falling to a median level of 0.2%, interest rates are about as low as they can go, which means the price of bonds is about as high as it can go. Plenty of people are fooled right now on the difference between real yields and nominal yields, and they're still lending, they're still purchasing bonds without understanding that the inflation rate is causing them to have a negative real yield. They're fooled by the nominal number, which still is positive. But very few investors will ever be fooled by a negative nominal yield. In fact, globally, the only investors who invest in negative debt, when you hear about negative interest rates happening from central banks in other countries around the world, the only ones who are investing in this negatively yielding debt that's negative from a nominal perspective, not just real, is going to be institutions that have no choice, such as pensions, who by law are required to invest a certain portion of their portfolio in certain durations of their government bonds. Now, I know I said that bonds don't have a place in a portfolio today if you actually care about profits, but there's one exception to that, in my opinion. And that is trading. If you are planning on trying to trade bonds, especially through instruments like ETFs that are just comprised of a basket of bonds, you can play on the Federal Reserve's moves. And if you think the Federal Reserve is going to increase or decrease their asset purchases, start winding down their balance sheet, raise or lower interest rates, you can make trades with these ETFs, not risking a ton of your portfolio, making bets on which way bonds will move. I've done that plenty of times in the past myself, and one way that I really like to do that is using options, because then you are using even less of your portfolio, and there are ways to use options where you're risking a very small amount. Your maximum potential you could lose is very small. The maximum you could gain is very large. Again, in a situation like that, when you talk about the risk to reward spectrum, your likelihood of making money on that is probably pretty small, because it's basically the opposite of just straight up buying a bond. But I've certainly used option strategies recently within the last 6 months, year, on bond ETFs. If you're interested in learning the beginner strategies, just the basics about how to use options, or if you're interested in upgrading your options trading skills and learning all the professional strategies, I've got 2 courses linked in the description below, one for beginners, one for advanced. And it might be worth it to just double check, contact your 401k provider or your retirement plan and see, number 1, are you invested or do you have any exposure at all to bonds in your portfolio? And number 2, is there any option to change your allocation? Because picking up pennies in front of a steamroller, it's kind of a funny image to imagine inside your head, but I promise it won't make you laugh if you get run over in your portfolio. As always, I really appreciate you guys. Thanks so much for watching. Have a good day.